Hey guys, thanks for tuning into another video. Doing this has been a lot of work, but it's also been very rewarding knowing that I get to help out the community. And so today we are going to talk about two Canadian telehealth stocks. So first, I want to cover the healthcare industry as a whole. This year, Deloitte published an article on the future of healthcare, and my two main takeaways from that article is that number one, low-income families are more prone to chronic conditions, and this ranges from people of color to those who don't have access to the proper resources. Number two, governments face rising need to address rising health concerns such as mental health, addiction, and affordability. I find these to be very big problems that the world as a whole will be facing. The inequality gap has gone even wider since the pandemic, and countries are only realizing now that they are spending way too much on healthcare and they will need solutions. Now combine this with what the US spent on national healthcare. $3.8 trillion in 2019 and $4 trillion in 2020. Now if we project it further to 2028, that's $6.19 trillion. That would account for 19.7% of the country's GDP, and the increase from 2020 onward would mean a compounded annual growth rate of 5.58%. So the reason why I'm so bullish on the healthcare and telehealth sector is because it's a disruptive technology that will address the problems that I noted earlier. So in this video, we are going to cover Cloudmd Software Services, ticker DOC, and WELL Health Technologies, ticker WELL. And while there are two companies in the telehealth space, both are very unique in their approach in delivering telehealth services. To give a better analysis of these companies, I will cover each company in depth in the way of one, giving an overview of the company, two, going over company fundamentals, and three, giving my thoughts and predictions of the stock moving forward. Cloudmd. They're a Canadian telehealth company looking to digitize the delivery of healthcare through all facets of technology, whether it be from the phone or the computer. Their aim for healthcare is to strengthen the engagement between patients and doctors by promoting a whole ecosystem that services everything the patient needs while also providing the doctors with the ability to do it. In terms of management experience, DOC has quite the lineup of experience ranging from business management and capital markets all the way to understanding the patient's needs personally. Unlike many of the other health tech CEOs out there, this company is run by Dr. Ihsan Hamza, who is an actual doctor with decades of experience in providing care to patients and also being one to understand the use of technology and its application in healthcare. Another notable figure is Mark Kohler, the chairman of DOC's board of directors. He has over 33 years of experience, with the most relevant being a strategic transformer of companies and a mergers and acquisitions specialist. He led the way to QHR's sale of Loblaws for $107 million. So the goal of providing an ecosystem of health services requires many different avenues of health demands to be met, and the company has been focused on M&A to ensure that they can provide that whole patient care. Apart from expanding their operations of ongoing medical clinics and telemedicine app, the company has bolstered their revenue streams to provide more services to more clientele and on a larger scale. The most notable revenue stream is their new enterprise health solutions. This is where DOC really feels like they can scale up and secure large contracts with employers, insurers, and other large corporations who need these services. This will be the company's most important division to date. The CEO has mentioned that they have already signed with large multinational clients to cross-sell their products and services. So you essentially have product and demand as employee and employer, and this has been one of the main channels that Cloudmd has been trying to break through. The pandemic has changed the world with health and well-being at the forefront, while other companies have yet to fully concentrate on providing all these services that are now seen as essential. Cloudmd has built a market-leading platform, so it's just a matter of making sure all these acquisitions integrate well together. And so what we have is that the company has laid out the groundwork and will just need to execute their vision moving forward. So forward multiples. DOC is trading at 3.6 times EV to revenue, and we're going to ignore EBITDA for companies that are not profitable or at break-even levels. So looking at industry peer comparisons, you can see that the company does trade at a EV to revenue discount compared to its larger competitors, WELL Health Technologies and Dialogue Health. Also, one thing to note is that a majority of these companies are not expected to forecast profitability with the exception of WELL. And this is also the case with the larger American telehealth companies. So onto the balance sheet. The company has a very healthy looking one.
You can see that at the end of 2020, the company has almost $60 million in cash, but all of this, including more, have been used to make strategic acquisitions that will allow for Cloudmd to build on their platform. The company has very little in debt in comparison to assets, and this is because the company likes to finance capital through issuing shares, and acquisitions have been made mostly through cash and equity offerings. I know dilution has been a concern for a lot of DOC investors, as the company in a span of a year and a half has done around 6 deals. The CEO has already mentioned that they will potentially take on more debt in the future to fund their expansion. On the income statement side, we see that the company has grown over 100% almost every quarter. That's pretty insane. But a big red flag that I see is that they reported gross margins of only 33% in Q4. We're going to need to keep an eye on this number. But one thing I can add to this is I think an explanation for this large decrease could be due to the company acquiring more brick and mortar type acquisitions like your traditional clinics that are going to be lower in margins. Expenses I see are growing faster than revenues, but I've seen much worse with some of our other telehealth companies like Amwell. It's not what you want to see, but it's going to be what you see with a company growing as fast as they are, so I might be able to overlook this, especially if I can see an improvement in the next quarter. And so one last note that I'll end off on is that the company's net loss almost doubled from Q3 to Q4.
Okay, so I think we saw a lot of good and bad in those financials, and I think if you were to give me a piece of paper with the name and industry blanked out and just let me see those numbers, I'd be pretty turned off by some of those flags. But what I can do to flip the narrative is to tell you that Cloudmd is a well-run company working in an industry that's only projected to grow. Okay, so next up we have WELL Health Technologies. They are also a Canadian telehealth company. They operate a portfolio of digital and clinical assets that include electronic medical records, allied care services, telehealth, digital apps, cybersecurity, and billing and back office services. So unlike Cloudmd, the WELL business model operates similarly to Warren Buffett's Berkshire Hathaway. The CEO Hamid Shabazi often likes to make the two comparisons. Essentially, each of WELL's business units serve as an important function in the healthcare industry. WELL looks to grow organically while also placing a strong emphasis on making strategic and disciplined acquisitions for companies that have shown an aptitude for being well run. So what they do is tech enable these companies, giving them everything they need in the way of support and technology, and this essentially allows the company to grow and scale more efficiently in a number of ways. So moving on to the management team, this is one of the reasons why I have a high conviction on WELL, and just to give you guys a brief history lesson, the CEO Hamid Shabazi founded a company called TO Networks that specialized in payment and processing solutions. He built it from the ground up in 1997 and later sold it to PayPal 20 years later. After the sale, the CEO, CFO, along with some other key members on the team on TO, all looked to build something together again. They discovered that healthcare was going to be the next industry to break out due to technology advances. The CEO, who I have a lot of respect for, is very transparent and often mentions that he didn't always do things perfectly and that there were a lot of lessons learned at TO. He let the company grow slow and organically for over a decade before making any acquisitions to scale up. It was only since 2014 where he learned from one of his mentors in the Canadian tech space the art of mergers and acquisitions. And so I hope this paints a picture on how experienced the management team is, 20 years plus experience, also a lot of mistakes learned. And something important to know about the telehealth industry, it has become an increasingly competitive space. There are bidding wars happening all over this M&A cycle, and you have companies like Teladoc, Amwell, who's backed by Google, Amazon also saying they want to make an entry into this space, but new investors should know that WELL also has a secret weapon of their own. Sir Li Ka-shing, the 30th richest man in the world, touted as Asia's Warren Buffett, Mr. Li has contributed to the funding of almost every financing deal that WELL has done since the very beginning. He's not only been a part of the capital front, but he's also had a large influence on the company. For example, the fact that WELL uses HSBC as one of their primary banks. No one really uses HSBC in Canada unless they have ties to Asia or the UK. Some of the businesses that WELL has also operate in Australia, where Mr. Li has strong business ties. And so I don't think it's a coincidence that this is happening. Mr. Li is definitely having an influence in helping the company connect the dots. So important catalysts on WELL. In the company's earnings call, they highlighted two very important up-and-coming catalysts that WYLYYF investors should be very excited about. First, they've been active on the M&A front, as usual, and have 9 letters of intent in the due diligence stage. They currently have a projected revenue run rate of $330 million and $80 million in EBITDA. So they are looking to get past that $400 million in revenue run rate and $100 million in EBITDA because of number 2. All this is to get ready for a NASDAQ uplisting. That's right. The company has mentioned this many times, and I am very confident that this is going to happen within the next year. Reasons being because as a Canadian company, they generate more USD than they do their own currency. Uplisting to a US exchange will also let them trade at a higher multiple, so I think there are obvious benefits to this. It's just a matter of time really, and given how the markets have been a little shaky lately, my guess is that they're waiting for a more opportune time. So the CRH acquisition is definitely something I have to talk about. On April 22nd, WYLYYF closed the acquisition of CRH for $369 million. And I know WYLYYF has made a lot of acquisitions to date, but this one I believe is the most important by far. There are 4 reasons to this because number 1, CRH is cash flow positive. The company posted $37 million USD in Q4 with adjusted operating EBITDA of $16.1 million, and this represents a 44% margin. While CRH is not going to give you growth levels to go crazy about, they are still projected to grow 20% revenues, which is a very good sign. They recently secured a $300 million credit line with JP Morgan on some of the best rates that you can get, and they will continue to execute along their pipeline of acquisitions, grow, and generate stable revenues for WYLYYF. This deal was done through an equity issuance where it made history in the TSX because the company raised money via equity offerings at a 25% premium to their share price. A company selling their shares for a premium is almost something that is unheard of, and it just shows to you the confidence that people have for this company. So once a startup posting losses like any growth company will finally be cash flow positive. This means that they will no longer be reliant on bought deals that dilute shareholders and will be able to compound their money and make strategic investments. So we are on revenue and share price projections. I am super excited to show you guys this because I've had this done for a long time. But before we move on, I would just like to add that I try to be on the more conservative side with my projections. And I have this projected until 2027, so it's a long time from now. And with the company doing as much as they are, it can easily become outdated. So this project spans up to the NEA acquisition by CRH. So this 340% growth in revenue may seem crazy, but if you follow the stock, you wouldn't be surprised about this. I'll quickly go over each of the assumptions that I made in the current and coming years for each of these line items. So operating expenses and G&A will follow in the way of the company's growth through acquisitions. I expect it to increase dramatically like we've seen with revenue. Depreciation shouldn't really change too much. I've adjusted this to 10%. Income tax recovery went from positive to negative after 2020. Since they'll start earning, it'll stay negative. So stock-based compensation, I expect this one to increase a fair amount just over the years, like with a lot of growth companies. Time-based earnout. When WYLYYF makes their acquisitions, they'll like to add what's called time-based earnouts, and this is an incentive for those companies to keep improving and growing their business. And the last 2 here aren't really too important. You can read why I have written in the notes, but we're going to skip those 2 because, yeah. So if we go back to revenue, I projected a mix of what analysts and the company are expecting for 2021 and 2022 without any further acquisitions. So this on its own should already be pretty conservative. And here you can see that I only have them growing at 35% and 30% a few years down the line. I think Hamed will disagree with me. And so what we get here, I want you guys to focus on 15 to 25 times multiples. You can see that is pretty consistent with analyst price targets. In fact, it's actually on the much lower end. Some project us to hit up to $13.50, but I'll keep my expectations lower with this projection. So when we look at a couple years, we can see the potential if they continue to execute, which I fully believe they can do and more. If we look up 5 years from now, 2026, you see a share price of around $19 to $31, which I think is very, very, very conservative. But like I said, I'd rather have lower expectations and be blown away. So my thoughts on WYLYYF. And I think my friends and family know how I feel about this stock. They've heard me talk about it a million times, and I just want to get it out there that there isn't a company that I am more bullish on than WELL Health Technologies. Everything about this company makes sense, and I know these last 8 months haven't been the most exciting for WELL investors. The company is doing great things, yet the share price hasn't moved much. But when we take everything into context, we know that there's a market correction going on for higher growth stocks, and a lot of telehealth companies, WELL Health's peers, are down quite a bit, yet the share price for WELL is already faring quite well on this front. Combine this with the short interest in the recent short report that was put out, and I won't comment on that because I think you know where I stand. I have full confidence in this company moving forward. I am long on WELL and have a time horizon of 10 years. So if there's a stock that you want me to cover, just leave a comment down below. And for those of you that are still watching this, thank you for watching this video. If you thought this video was educational or entertaining in any way, then I encourage you to share it with your friends, and I'll see you next time when we cover weed stocks.